The broadcast is now starting. All attendees are in listen-only mode.
Good evening, and thank you for joining us for our fourth quarter 2019 market webinar. We will be going over market trends, macro developments, and their implications for investors. Tonight's presenter is Sean Kennefic Rogers. Sean currently holds the Chartered Financial Analyst designation and serves as the Chief Investment Officer here at Ironwood. Without further ado, Sean, the floor is yours.
Thanks, Jared, and thanks everyone for joining on the call tonight. We're going to go through the current expansion. Since our last call, it officially became the longest ever recorded, so we'll talk about that. We'll talk about earnings. We're in the deep earnings season. In fact, today was the most companies released earnings this morning and this afternoon. So we'll talk a little bit about how earnings are looking and how that impacts things going forward. Since last call, we actually got phase one of a trade deal with China, so we'll kind of talk about that a little bit. And another item that I'd like to talk about is the silent shift that has occurred over the last 2 months, and we'll go over that a little bit here at the end of the presentation. So I'll leave it here for the disclosures for a second, make the attorneys happy. All right, so this expansion is officially now the longest expansion that we've ever seen. However, as you can see here on the chart on the right, it is by far the strongest expansion. So number of quarters is on the bottom here, and then we've got the cumulative GDP growth, and we're about half of what we have seen in previous expansions. They happened quicker, so they were more of a boom. So far, we've had a slow plow horse economy ever since the Great Recession. I often get folks that are concerned with the timing of, is this a good time to add cash to the portfolio? Is this a good time to be investing? Should I wait until the next recession? This slide I thought was a really good slide to put in here, because my answer to those folks is I don't know. And anyone who tries to tell you that they do know with any certainty is probably trying to fool you and probably fooling themselves as well. This slide shows that if we get it wrong, if we get the equity market peak wrong by 3 months, then we have a potential of losing out on 8% return, which almost negates the 12 months after the market peak, which we generally see a 14% pullback. Now, granted, you're on a 14% of a higher number, but literally, we've got to get this thing exactly perfect, and then we may save ourselves 14% if we got it exactly right. If we get it wrong, and let's say that the market peak is not, the markets are stone's throw away from all-time highs. So the S&P 500 is about 1% from all-time highs. If we get it wrong by 2 years and we try and make changes in the portfolio today, and the market continues to go up for another 2 years, we could potentially be missing out on 41% upside, which more than makes up for the drop in equity markets after a market peak. So it's not really about the timing. It's impossible to get the timing wrong or right. It's very easy to get the timing wrong. And if you get it wrong, there's much more consequence than if you get it exactly right. So that's the point of this slide, and that's really why I wanted to try and start with this slide, is we are getting long on this recession. But like I showed in the previous slide, it doesn't mean that growth is going to stop. It doesn't mean that companies can't earn earn money, increase revenues, control costs, and give us a decent return on our stock investments. So we definitely want to make sure that we keep it in perspective. Now, over long periods of time, and I've talked about this before, but the S&P 500 is just one stock market. It happens to be large cap US. It tends to go sideways for a period of time, call it 10 to 15 years, and then up for 10 to 15 years, and then sideways 10 to 15 years and up for 10 to 15 years, sideways and up. So you get the point here. There's some consolidation that happens. The problem is we don't know what the next 10 years is going to bring us. And so we don't want to just bet on only the S&P 500. We want to add some asset classes into the mix. And so just to illustrate my point, if you're in the camp where you think this expansion has gone on very long, the S&P 500 has done very well, and you think, hey, we might be in one of these sideways markets, well, we may. Remember, if you get it wrong, it's going to cost you. If you get it exactly right, it might save you a little bit. There's a better way than trying to time the market. And the better way, and I try and illustrate it in the next couple of slides, but it's all about balance. It's all about diversification. So I picked one of these sideways markets. I picked basically from 2000 until 2010. So this part of this flat sideways line right here. You can see here are some asset classes. Just to give you an idea, we've got real estate, emerging markets, market neutral, bonds, a balanced portfolio, commodities, small cap, international, developed international, and then the S&P 500. So from 2000, if we would have invested on January 1st, 2000, and then if we were to look at what our returns of our portfolio were at the end of 2009, cumulatively, the S&P 500, had you just put your money in the S&P 500, you would have lost 9.1% cumulatively over that entire 10-year period of time. Now, if you would have picked, luckily, and you would have picked real estate, you would have had the best performance of these asset classes over that period of time. And instead of being down 9%, your portfolio would be up 180%. Now, unfortunately, if we were talking and it was January 1st, 2000, I wouldn't have been able to tell you, and no one would have been able to tell you which of these asset classes would have the best return over the next 10 years. We would have had some educated guesses based on valuations in 2000. Remember, valuations kind of got a little crazy in 2000, especially with the S&P 500. And so you could have probably predicted that the S&P probably wouldn't have done as well as it did the previous 10 years. But knowing, where these asset classes would line up would almost be impossible. However, if you had a balanced or diversified portfolio, instead of losing 9.1% over that period, you would have made 60%, 59.9%. Why is that important? Well, let's take a look here. If you were retiring in 2000 and your investment strategy was, you know what, I'm just going to buy the S&P 500. It's done really well. Bring yourself back to January 1st, 2000, the dot-com era. In hindsight, it's like, oh yeah, of course we were in a bubble. However, if we're looking at that and we invest $1 million to start off, you retired, you invest $1 million. Every year you take $40,000 out of the portfolio. Where would you be at the end of that 10-year period? Well, if you invested in the S&P 500, because of those first couple of years were really bad, you'd have a portfolio in 10 years that is only worth 488,000. If you're pulling out 40,000 a year, that's a hefty percentage of your portfolio now and every year thereafter. If you were in the balanced portfolio, the diversified portfolio, yeah, you would have lost some value. You would have lost almost 20% the first couple of years, including your $40,000 withdrawals. But at the end of the 10-year period, you actually have more money than you started. Okay? Now, this is a very unique period of time. I'm not saying that the next 10 years is going to look like this. I'm just saying when you have an asset class like the S&P 500 that has had a very, very good run over the last 10 years, you have to be careful with what your expectations for returns over the next 10 years are going to be. So I went ahead and I just said, okay, well, let's continue this and let's look since that 2000 and let's pull it all the way to 2018. So the S&P 500 definitely rebounded, but this investor, because they've been taking $40,000 out every year, they weren't able to participate in the upside of the S&P 500 as much as they would have had they not been taking money out of their portfolio. And so this investor now, it was a better period than the first 10 years, but they're still below where they started. They've been able to get $40,000 out of their portfolio every year, but they're at $635,000 versus the person that had the less aggressive portfolio, had some bonds, had some international, emerging markets, real estate, market neutral, had the more diversified portfolio, not only took the same amount of withdrawals out of their portfolio, 40,000 a year, but they also have 20% bigger portfolio after 18 years than the person who invested in the S&P 500. So just trying to show the importance of sequence of returns and why it is so important not to focus on the best asset class over any period of time and try and get the highest rate of return, but it's more about balance and it's more about what you're trying to get accomplished. Okay, so that's kind of where we are. We're in the longest, not the strongest, but the longest expansion that we've seen. What's changed since the fourth quarter of 2018? So if everybody remembers, the S&P 500 dropped 20% at the end of 2018, basically 19.8%. Well, since then, the Fed has cut twice, so they've cut 50 basis points. The 10-year Treasury has dropped 50 basis points since January 1st and is currently sitting at 1.77%. Since last September, really, about a little over a year ago, the 10-year Treasury was at 3.25%. So we've dropped 150 basis points since about a year ago. That is a big move in treasuries. Domestic stock market has done a lot better since the drawdown in the last quarter of 2018. The biggest thing is that we averted the recession thus far. And markets price in the risk of a recession very quickly. And so when news comes out that says we're slowing and the yield curve inverts, maybe you get some bad news, people start forecasting a recession way ahead of where it is. And then if things improve, the market snaps back. And so it's a very difficult process to move in and out of the market, because the market on a day-by-day basis is a probability mechanism, and it's discounting future outcomes. So a couple of things also happened. In August, there was a 3-day period where the 2-year Treasury yield was higher than the 10-year Treasury yield. It was about 3 days that this happened. Now, since then, since the Fed has come and cut twice since then, the yield spread is now at 19 basis points, which is back to where it was basically at the beginning of the year, and makes people a little bit more comfortable that, hey, you know, a recession is not on the horizon, on the near horizon. And then lastly, we have a little trade deal optimism. Phase one announced. Not a lot to talk about for phase one. It's really just kind of kicking the can down the road, and we'll see. I mean, there are some things that the tariffs are not going to increase. We'll see what officially comes of it, but there definitely is a little less tension, and the market is a little less worried about any more increases in tariffs. So we're moving in the right direction. Whether we get a grand bargain, a grand deal or not, we'll see. But the trade rhetoric, the trade war, tiff, whatever you want to call it, has definitely had an impact on manufacturing and has had an impact on global growth in general. And you can see that easily. We went through a bottoming out process here in August, and it looks like we're coming off of that bottoming process. There's a PMI number, a U.S. PMI number this morning or today that came out that looked a lot better than had it been anticipated. At 51.5, I believe was the number. So we've gone through this bottoming process that we believe was really self-inflicted by this trade, tariff, war, tiff, whatever you want to call it. And we think that the trade optimism is why we'll start to see these things kind of reverse. And just to put this into perspective, you can see in 2018, when we initially started talking about these tariffs, global manufacturing just fell off a cliff. And you can see right here, it started to bottom out and started to come back up. Now, services definitely dropped globally, but they're still above 50, which means we're still in an expansion. And you can see a couple of other time frames when this happened. We had a drop in manufacturing in 2010, basically until 2012, and then an increase. Well, guess what happened from this point here to this point here? Well, in 2013, the S&P 500 during this where we were in contraction area on manufacturing, and then we went up and expanded even at a greater pace, which I think is possible again. The S&P 500 over this 2013 period was up 33%. And once again, it was pricing in recession. Recession didn't happen. Market whipsaws right back. Then it happened again in 2014 through 2016. We had not very good markets in 2014 and 15. And then in 2016, we were up 12%. And 2017, we were up 22%. And international markets were even up higher than that. So when you see this downturn, okay, you know, we had the Q4, we had August where we came down a bunch, and now we're starting to turn the corner. If this in fact does improve, I anticipate the stock markets improving lockstep with some of this global growth stuff. And we think that has a lot to do with this trade rhetoric. And granted, we didn't get a grand deal, but at least we got a little bit of optimism. You can see that trade basically is falling off of a cliff here, world trade volume. It doesn't impact the U.S. as much because the U.S. only exports 8% of their GDP. It impacts a lot of these other countries a lot more. And so that's why over the past year and a half, you've seen the U.S. outperform a lot of these other countries because the U.S. is basically, one, leading the charge on these trade deals, and they know they have the leverage because it's not as important to the U.S. as other countries. and the president is using that as leverage to get better deals, in his opinion. So that's kind of what we've been going through. If we end up with better deals, less tariffs, I think there's going to be a lot of outside the United States markets that recover very nicely. And we're already starting to see that. And later in the presentation, we'll kind of show that. But let's start, before we go outside the United States, let's stay inside the United States and kind of see what's been going on. I talked about the bond rates. So the 10-year Treasury is currently at 1.77% versus 3.25% about a year ago. If you haven't looked into refinancing and you have a loan that's 4% or higher, you may want to talk to your advisor about possibly looking into refinancing. That's one good thing about rates coming down. Believe it or not, the 10-year Treasury went below 1.5 for a little while. It's since gone up a bit. And then once again, we talked about that 10-year minus the 2-year, the yield spread that a lot of folks pay attention to. They don't want it to go negative. That is now at 19 basis points, which is the highest it's been for a while. ISM manufacturing, like I showed in the previous slides, trending downward, but once again, looks like that probably is going to start to come back up. And then once again, services, which is a much bigger portion of the U.S. economy, is still, they're not great numbers, but they're above 50, which means we're expansionary. And we've had 116 straight months of expansion in that index. The jobs market looks fantastic. We've gained 157,000 jobs in the last quarter, and that brings our yearly average per month new jobs to 161,000 per month. Last year we came in a little hotter. We had the tax breaks, and we had deregulation that really caused a lot of hiring, and it slowed down a little bit. But at 161,000 per month, if we keep pace like that, that's gonna be taking slack out of the economy, and that's gonna probably even drop the unemployment rate even lower. And we're starting to see wages increase by 3.6% year over year. Once that number gets to about 4, that's when we've in the past seen companies have a hard time with profits when wages start to increase by more than 4%. So that's definitely something we're keeping an eye on. Jobless claims as low as they've been since 1970. Basically, the job market is as pretty much as good as we've seen it in history, and it's not showing any signs of slowing down. The consumer is healthy, spending money, balance sheet looks good. It's very difficult for the U.S. economy to go into recession when you have this kind of a job market and this strong of a consumer. GDP growth definitely has slowed down, which was anticipated a little bit. Maybe it's a little more than most folks anticipated. Most folks thought, we get a bump because of the tax lowering and because of the deregulation, which we got in 2018. 2019 started with 3.1 in Q1, Q2 2%, Q3 looks very similar to Q2, and we'll have to continue to keep an eye on that GDP growth in the future. This slide just shows the phenomenon that I was talking about earlier, where in 2018, at the end of the year is where we got all of the losses, and it basically was everyone was pricing in recession. And so when you price in recession, you don't pay as much in multiples. And so the multiples is what drove the negative stock returns in 2018. It was people pricing in a recession risk. And then January 1st, right around there, the Fed started talking about being more dovish. We started getting a little bit better numbers. And then everybody just looks at the data and says, you know what, we're not really gonna be in a recession. And then in May, and so things get better. And then in May, the president starts tweeting about more tariffs, and the market comes back down. And it's just, you get these whipsaws, and it's basically pricing in recession. Everyone's fearful because the expansion is the now longest in history, even though it's not the strongest. People just get real gun shy and trigger happy about pricing in recessions, and that's why you get this market volatility that we've seen over the last 2 years. But really, it's been 2 years almost, and we're pretty close to the prices. If you look on a global basis, we're about where we were at the beginning of 2017, or excuse me, 2018. So about just a little less than 2 years ago, markets ran up after 2017. And January, I believe it was 26th, 2018. If you look at some of the global indices, we're right where we were about a year and a half, 2 years ago. So we have had a consolidation, and there has been a lot of stuff that's gone on. And what we see is if some of these things that we think are going to happen positively, especially outside the United States, we could see a jump upward in equity prices globally. Long run, the point of this slide here is long run earnings. Your stock returns mostly come from earnings and dividends. So those are two very important things. We want to make sure that our stocks that we own have good earnings and have good dividends. The other thing we want to make sure is we want to know what valuations we're entering a market in. And this is a chart of the S&P 500, and it shows the last 3 peaks here. We've got March 24th, 2000. The index was at 1527. The PE, the forward PE at that time was 27. That's a very high PE multiple. The dividend yield was 1.4%. The dividend, that's a very low dividend yield for US stocks. The 10-year treasury at that time was 6.2%. So just showing other time periods to get an idea of where we are now. In October 2007, we're at 1565 on the S&P 500. PE multiple of 15.5, 15.7. That's not unreasonable with a treasury at 4.7%. 15, 16 multiple, that's reasonable. Dividend yield 1.9%. That's reasonable. Maybe a little lower, but than I'd like, but not much. Well, it wasn't necessarily that valuations were stretched in 2007. It was that we went through a financial crisis. Real estate was going crazy at that time, and it was a different type of excess. And now you look at September 30th, which is pretty close to where we are now. We're a little bit better than that, but we're at about 3,000 on the S&P 500 as of today, 3,005. PE ratio is 16.9. Dividend yield is just right around 2%. Our 10-year treasury is at 1.77. So when you have a 10-year treasury that's that low, you could make an argument that your price to earnings multiple in relation to history, you could say, a higher multiple is okay given the fact that rates are so low. And so the fact that this is 16.9, it's definitely not cheap, but it's not overly extremely expensive either. I would just be on the cautionary side. You can see the 25-year average is 16.22, so we are above that. If you look at some other valuation measures, not just the price to earnings, but you look at some of these other ones, you can see if we look at the standard deviation of overvalued versus undervalued, five of these metrics are telling us that we're a little bit overvalued on the S&P 500 in relation to history. Only one of them, only one of them shows us that we're undervalued, and that one has to do with bonds. And I would tell you that it probably isn't telling you that we're undervalued on the S&P 500 as much as it's telling us that we're way overvalued on our bonds, and our bond yields are ridiculously low right now. So I'm not sure I'm looking at this and saying this is telling me the S&P 500 is cheap. It's telling me relative to bonds, the S&P 500 is cheap. But really, in my opinion, what this is telling us is that bonds are really overvalued. The other five are telling us the S&P 500 is not expensive. It's not cheap. It's a little overpriced, maybe. Which brings me to my next slide. Okay, what's the concentration of the S&P 500? Something that we like to take a look at. Well, the S&P 500 is 500 companies. If we look at the top 10 companies here, Walmart, Johnson & Johnson, JP Morgan, Visa, Berkshire, Facebook, Google, Amazon, Microsoft, Apple. Okay, let's go through the top 5 now. Facebook, tech. Google, tech. Amazon, you could call it tech. Microsoft, tech. Apple, tech. If you look at folks who don't manage portfolios professionally, you will probably find these 5 companies in their portfolio in very heavy weightings. So this is showing us that 10 companies in the S&P 500 represent 25% of the S&P 500. The S&P 500 is a market cap weighted index, meaning if you own the S&P 500 market cap weighted, you own 25% in these 10 names. At the beginning of 2000, the top 10 500 constituted 22% of total market cap. So we're above where we were in 2000. I'm not saying that means that we're going to see another huge downturn on the S&P 500. I'm just saying that it starts to get a little bit, when it starts to get concentrated like this, it means that people have an overweight in relation to other asset classes in these 5 to 10 names. Another way to look at it is look at the 5 largest in history. In March of 2001, right before we had a big correction, 18.8%. The current is 15.7%. Those top 5 represent 15.7. So you can see here, when things get concentrated, another time it was concentrated was November 2008, where it spiked up. 2011, where you had some market issues. So we don't want to sound the fire alarm here, but we need to make sure that we know what we're investing in. There's many times that I hear on TV or I hear folks talk, I just buy the S&P 500. Well, that has been a wonderful strategy over the last 10 years. Ironwood has had some pretty good exposure to the S&P 500 over the last 10 years. We have been reducing that exposure over the last several years because it's just not as attractive, and there are some things that concern us. It doesn't mean that it's going to get cut in half. It just means that we don't like it as much as some other things that are available, and that over the next 10 years, we expect maybe 5% returns from the S&P 500, where we expect higher returns from things like developed international and emerging markets. Earnings at the end of 2018, analysts got pretty pessimistic here and brought down their earnings estimates, but they slowly revised them back up to basically where they were before all the noise happened, and actually even a little bit above that. It looks like Q3 earnings are going to be about 2 to 3% above expectations, we're still early in the earnings season. After today, about a little less than 50% of the companies will have reported, and we're at about 2 to 3% above expectations. So when they update this line, I anticipate it to be a little bit higher here. And then this is just the math to get to 16.9 on a price to earnings multiple. I forgot to put 3005 there. Now, once again, I think you could probably make an argument that the S&P 500 could go even higher with a higher multiple because we're at such a low interest rate environment. But for some other reasons, we've definitely trimmed back our S&P 500 exposure. It doesn't mean we've eliminated it. It's still one of the largest holdings in our portfolio. It's just we have a lot less than we used to. Revenues look pretty good. Q2, Q3, anytime this year, up 3% for the year, not horrible. Margins are definitely where the earnings per share growth losses have been. And to counteract that, it's been share repurchases that have washed those margin pressures. And so I'm going to break this down a little bit. So here's our net profit margins. Net profit margins have gone down for 3 quarters in a row now on a year-over-year basis. That hasn't happened very often, and when it does, it hasn't tended to be that great of an indicator. But in 2018, we were coming off of really extremely high comps. Q3 here was the highest profit margin that has been tracked. FactSet started tracking these in 2008. So 12% profit margin is the highest for the S&P 500. A lot of that had to do with the tax changes. And so you had profit margins increase, and you had companies start to announce, okay, we're going to give bonuses, we're going to buy back shares, we're going to increase wages. And so now all of those things that have happened are now decreasing the profit margins for this year. Of the companies that had reported as of last week, 32% of the companies cited wages and labor costs as a reason for their profit margins being lower, and 21% of companies cited raw materials and input costs. So that could be tariff related, trade related, and then just the fact that we have a tight labor market and people are getting paid more. Wages are going up, which is going to have an impact on profit margins, but it's also going to give consumers more money to go spend. So it's you have to go full circle on these things. Okay, so here's that's profit margins. The other thing that happened last year because of the tax cuts was we saw an enormous amount of share buybacks, and 2019 looks very similar. 2018 was really high, and thus far 2019 looks, it's not quite as high, but it's still pretty good. And if you've got these buybacks, all it's going to do is improve future earnings because there's less shares outstanding. So on a per share basis, all else being equal, the less shares you have the same earnings, you're going to have a better earnings per share number. What companies are not doing is increasing capital expenditures. You can see they've taken those tax gains, those tax windfall from the tax change. They have not really been spending it with capital expenditures. We think that probably is some to do with the trade war that's been going on, and they've been opting to invest it, just buy back shares and give dividends. And so that's what we've been seeing. If some of the trade rhetoric does continue in the manner that it is, we believe this capital expenditures could reverse and go higher, which then would help those earnings and revenues from S&P 500 companies in the future. So currently we're at 16.9 earnings multiple. If you look at the next 12 months, where what will the S&P 500 do over the next 12 months? We have no idea based on that. If we look at the next 5 years, we know that the lower your multiple, the higher the next 10-year or next 5 years return is. So the higher this multiple goes, the further down this line we go, and the worse our next 5 years return is expected to be. So with a 17 multiple, that's why I'm telling you that our expectations over the next 10 years for the S&P 500 are not as high as they were for the previous 10 years. So if we look at 10 years ago, it was October 2009. That was a very good time to be investing in the S&P 500. You're probably up over 10% per year if you're invested. I don't have the exact math there, but it's got to be over 10% per year from October 2009 through October 2019. So I highly doubt that the next 10 years you're going to get over 10%. It could happen, definitely could happen, but I would not expect it. I would expect something more like 5 or 6% returns from the S&P 500 over the next 10 years, given where we are right now. Unemployment and wages. We talked about this a little bit, but folks, wages are going up. The unemployment rate's coming down, 3.5%. This labor market you can't get much better than this. I'd like to see the wages be between 3.5% and 4%. That's kind of a sweet spot. If we stay between 3.5% and 4%, I think that probably portends well for aggressive assets. If we go above 4, I'd start getting worried about margin pressure. But that 3.5 to 4, kind of where we are right now, we could stay in that sweet spot for a little bit. Consumers, we talked about this. I'm not going to spend too much time. Consumers are still in a fantastic spot. They've got $8 of assets for every dollar of liability. Net worth is at an all-time high. Household debt service, we've got low mortgage rates. So we got low oil prices. The consumer is definitely in a good spot. Federal finances are not as cheery as the consumer. We are spending, we've got a significant deficit this year, and it doesn't seem to be going away. Half of our budget, a little over half of our budget, is Social Security and Medicare. There's a bill that has picked up steam that's called the Social Security 2100 bill. I'd anticipate some more on that in the next year or so, but we've got to get a handle on Social Security, and we've got to get a handle on Medicare. And this federal finances are definitely starting to concern me. At interest rates at 1.8%, 1.77%, not a big deal because we can finance them. But if that rate, overnight were to go to 4%, it would be a lot more difficult for the U.S. to pay for some of these outstanding debts that we have. GDP has definitely slowed down over the past year. Consumption's still been the driver. We're probably looking at about 2% for Q3. That number should come out here in the next week or so. And then year over year, we're at 2.3%, which is the average over this expansion. This will be a very, if we can get some productivity growth, like we've seen over the past couple of years, we might be able to run at a little bit higher rate than 2%, 2.5%. Maybe we're at 2.5%, 3%. But it's yet to be seen on how this economy is going to look post some of these trade impacts. So it'll be nice to see how things play out without some of this noise on the Mexico-Canada trade deal, the Japan trade deal, and the China trade deal. Which brings us to international. We are a big fan of international stocks right now. We believe that on a value basis, they're a lot more attractive than large cap domestic, and our portfolio reflects that. Europe definitely has been impacted by the trade wars, and net exports have caused some pain. But you can see Europe has a declining unemployment rate, increasing wage growth, very similar story to the US. Demand has picked up. And we expect when these trade talks start to pan out and we have less worries about tariffs and trade wars, that some of these uncertainties will be taken out of the market and these economies can pick back up again. China obviously has been impacted by the trade war with the US. Supply chains have been disrupted. Folks have been putting on hold things. Once again, we have phase one. It looks like we're moving toward the right direction. Whether we get there or not, there's still a lot up in the air. But on the current trajectory, we believe some of these things are going to start to improve. And now we're seeing fiscal stimulus again. And so if we do have some peace on these trade talks and we start to get some agreements and some of this uncertainty is pulled away from the markets, I think that you could have a really nice leg up, in particularly in some of these emerging markets and some of these outside the United States developed markets. This is just looking at emerging markets on a price to book ratio versus the S&P. You can see it's much cheaper than it normally is in comparison with the S&P 500. I'm not going to talk about this because we're going to talk about that a little later. International performance versus U.S. performance. You can see it goes through cycles where the U.S. outperforms international and then vice versa. It's been about 12 years. We've had about 136% of outperformance compared to developed international. And so we believe that we're going to start to see international outperform U.S. markets. And in fact, over the last 2 or so months, we actually have seen that. And when we talk about the stealth move here, that'll be one of the areas that we talk about. Just putting things into perspective, PE multiple, at the end of September, PE multiple for the S&P 17 versus developed outside the U.S. is at 13.4, whereas the 20-year average, U.S. is above the 20-year average, whereas all country world index ex-U.S. is below the 20-year average. It just tells me that I could make an argument that the PE multiple should be higher than the 20-year average because we're at 1.77 on the 10-year treasury. If I can make that argument, then I should also make the argument that international should be above 13.8 times multiple because of the same reason. However, it's not. It's under. So that tells me that this is a much more attractive area going forward than this one is. If I look at dividend yield, I'm at 2% on the U.S. Outside the U.S., I'm at 3.4%. Once again, 20-year average, 2.1. So I'm a little bit below that. Not too bad. 3.1, I'm above that. So, all else being equal, the international markets, any country outside the United States looks a lot more attractive here. Central banks, a lot has happened. We've had 2 rate cuts now. We have negative real yields, as you can see here. And history would tell us that negative real yields don't typically happen very often or for very long. We went negative in the 70s, and boom, we flew back up, and we went negative in the late 70s, early 80s, and boom, we came back up pretty quick. And then it happened again in 2011, 2012, and back up, and then again in 2015, 2016, and back up, and now in 2019 it happened. And we anticipate those rates going back up if the things we think are going to happen, which is avoid a recession, trade war calms down, manufacturing picks back up. We believe that at 1.77% on the 10-year Treasury, that is pricing in a lot of bad news. That's pricing in basically a recession in the bond market, and that's why, all else being equal, we're very pessimistic about bonds, especially long-term bonds. Now, you've got to have them in a diversified portfolio because you never know what could happen, and what we think is going to happen may not happen. But we definitely want to put what we think is going to happen, what we think the educated data is telling us is going to happen, and that we believe that means that rates go higher from here, which means we want to be short on the curve, which means we probably want to have a little bit more credit exposure to get a little bit higher yield, which is what we've done in the portfolio. We've tilted it to that direction. Fed expectations, basically the market is predicting another 2 to 4 rate cuts, whereas the Fed's thinking probably more like 1 rate cut, maybe. This just tells you the starting bond yield. So if you're looking at the 10-year Treasury right now, you're at 1.77%. That's going to give you a good idea of what your 10-year return is going to be, the starting yield. So if you buy a bond right now and you hold it for 10 years, the expectation would be that you're going to earn 1.77% from that. Not a very good 10-year investment option. We have better options that we believe are out there, but that's what the bond market is pricing in today. So how do we navigate? Well, with bond rates as low as they are, that means cash is not paying very much. A money market might be paying us just enough to cover inflation, and a savings account is not even getting close to that, not even getting close to the amount of money. So cash is not a great option. We'll keep up with inflation, but for the most part, unless you're trying to time the market, cash is not a good long-term asset class. And it's more of we need cash because we have expenses in the next 3 years and we don't know what's going to happen with the portfolio. So we want to make sure that we have enough cash on hand. That's what cash is good for expenses that we know are coming up in the next 1 to 3 years. As far as an investment, not a great investment tool for a long-term approach. S&P 500 earnings yield versus the worst investment grade corporate yield. Once again, we talked about this a little bit before. There's a big gap here, and the earnings yield is at 6.6%. I'm sorry, is at 5.9%, whereas the worst investment grade bond is at 3.9%, and that spread is 2.1%. That does tell me that if we're looking at the S&P 500 or the worst investment grade bonds there are, I would rather own the S&P 500. However, that doesn't really tell the whole story. It only tells you that in relation to bonds, the S&P 500 is probably a better bet over the next 10 years. So we just want to keep in mind, okay, well, that equities are probably a decent place if we have 10 years time horizon or more, then equities, S&P, possibly others are probably a better investment than the Moody's BAA yield. Earnings and profit margins, we already talked about these. I'm not going to spend a lot of time there. International, we already talked about that. I'm going to kind of skip that. Commodities. Commodities is one that really has underperformed for like the last 4 or 5 years. If I were to go back to that chart from 2000 to 2009, one of the asset classes that did well when a lot of those stocks did poorly was commodities. In 2000, 2001, commodities did pretty well. I'm not saying that it's going to do well tomorrow, but it's definitely something we want in the portfolio. And you can see commodity prices in relation to history here are showing that commodities are probably a decent buy. Unfortunately, it's pretty hard when they've had such a bad return over the last 3-4 years, but it definitely is a good risk reduction tool that we have, and we're getting a pretty good deal. So we have about 5% in most portfolios. We have about 5-6% in commodities exposure inside the portfolio, and it's a hedge in case commodity prices do spike. A case for bonds. You probably by now think I hate bonds, which at the current juncture, I definitely am not a fan of bonds. However, no matter how good we think we are, how much we can predict the future, which is basically you can't, we don't know what's going to happen tomorrow. And if bond rates go from 1.77% to 1%, which is possible, I don't think it's probable, but it's definitely possible, then we'd be very happy that we have some bonds in our portfolio. And so that's the reason we have bonds, is to smooth out our ride. So if we were to look at a different time frame than we were in the earlier cases, but we were to invest $100,000 and just let it ride in a 60-40 portfolio versus an S&P 500 portfolio, one that has 40% bonds, one that has no bonds, you can see that during really bad periods of time, it gets a little dicey. Your portfolio is worth $70,000 in September 2002, and it's worth $91,000 in that same period if you're a little less aggressive. So you could probably go to sleep at night if you've only lost 9%, whereas if you've lost 30%, it's probably gonna make you a little bit more nervous. Now, granted, it recovered and almost got back up to getting to that 60-40 portfolio. Before then, we had another huge drop. And once again, now you've invested for 10 years and you're down 30%, 29%. And now we're looking at this as the worst possible moment. But if you were in a 60-40 portfolio in that same period of time, you'd still have made money. Nothing to write home about, $5,000. But it just shows you that, yes, in the right time frame, the S&P 500 can significantly outperform a 60-40, but it's these drawdowns that we're trying to protect ourselves from. And during those drawdowns, especially that we're looking at this example here, and no one's taking any money out of any of these portfolios. If you start to throw in that you're pulling out money from these portfolios, the volatility of the S&P 500 will eat you up when you have to take a certain amount from the portfolio and you're taken out at a very inopportune time. And so that's why bonds, even though I don't think they're very attractive right now, are a must in a properly diversified portfolio. We'll skip some of these. Basically, these two slides here show us a really good day in the stock market. A really bad day in the stock market is a really bad year in the bond market. So you have a lot less volatility with bonds than you do with stocks. Stocks, on average, they go down intra-year by almost 14%, whereas bonds only have a 3.1% intra-year decline. So much less volatile. And that's why they're a good asset class to own inside of a diversified portfolio. Asset classes since 2004, and we can kind of see, what the return is. Year to date, REITs have been the best performer, up almost 30%. Jared was telling me before this call, they're up over 30% now. Now, earlier this year, we got rid of REITs in all of our portfolios because the valuation of REITs showed us that they were very expensive in relation to other asset classes. So we actually got rid of the 3% that we had in most portfolios. We completely got rid of it. They're just not attractive at these levels, in our opinion. We put some of those proceeds into small cap US, into developed international, and into emerging markets, where we see over the next 10 years a lot better outcomes happening. Now, let's get to the silent shift here. So here are relative returns, and you can see that on this graph, if these lines are going down, that means value is outperforming, international is outperforming, and small cap is outperforming. And at the end of August, we saw a huge shift. The first 10 days of September, I mean, look at this value over growth. In 10 days, it was about 8% relative performance out of growth, out of tech, out of Amazon, out of Google, out of all those 10 companies that were in the S&P 500. A lot of those were on the growth side, and it was into other companies that have been out of favor for a long time. Value. Also, small caps outperformed significantly over the same period of time. Now, if you look at this over the past 2 months, you can kind of start to see a trend. Now, they've picked up here in the last couple of days, but you definitely saw a turning point here. And at the beginning of September, we saw this dramatic shift here. And look at international. It's been a steady grind where international has outperformed domestic since about the end of August. So the portfolio is definitely positioned to take advantage of this type of a trend. And we're excited because you're finally starting to see that play out. And the portfolio has done very well in September and very well in October because of these trends. And then the trends have not been enough yet to make us change our overweight and our underweights. You can see the things we're overweight. We haven't changed this at all since last quarter. Small cap, developed international, emerging market equities, and emerging market debt, which has done fantastic recently. Then we're underweight long duration fixed income, large cap domestic. We prefer international, like I said. REITs and utilities we no longer have in the portfolio. We've completely gotten rid of that in most people's portfolio unless they had tax ramifications. But for the most part, these are out of portfolios at this time until they become a little bit more attractive. With that, I'm going to open it up to questions. And Jared, go ahead and ask the questions.
So far, I'm not seeing any questions from any of the attendees. I'm going to ask Scene a couple. If you guys have any questions, feel free to enter them into the chat box, and I will relay them to Scene. Scene, we talked about the decline in net profit margins, the increased concentration of the S&P 500, and where it stands currently as far as the forward PE. All negative omens. Can you shed some light on why we're still comfortable holding the S&P 500 and want to keep that exposure?
Yeah, it goes back to the chart where we can't time things. Let me get to that chart here real quick. Actually, there's probably a little faster way to do this. Okay, so this chart right here is why we still hold the S&P 500. So I'm not smart enough to know exactly when things are going to shift. I mean, we can look at trends and we can see things. We can look at valuations, but the market does what the market wants to do. And sometimes it doesn't make a lot of sense. If you were looking at this in 2000, if you were looking at this in 99, if you were looking at this in 98, you'd be like, the S&P can't continue to do what it's doing. And you would have been wrong. And for a couple more years, you would have had stellar returns from the S&P 500. And so because of that, we don't know if the S&P 500 is at a market peak today, or if it's going to be 2 years from now. And if it's 2 years from now and we miss out on 41% return from the S&P 500, then we've done a disservice to our clients. So yes, we think that there are other things that are more attractive, but we're not going to abandon the S&P 500. If the S&P 500 keeps going higher and keeps becoming less attractive, we will reduce our exposure over time. But we're not going to just eliminate the position, especially like an S&P 500. With REITs and utilities, those are small enough positions in our portfolio where it doesn't make a lot of sense to go from 3% to 2% to 0%, or from 2% to 0% to 1%. And so we made those, and those moves actually happened a lot quicker than the S&P 500. So we were okay getting rid of those. But the S&P 500, we're never going to just get rid of the S&P 500. And it has a lot to do with that. It's impossible to know the timing. We can lessen the impact by reducing our exposure, but we're not going to want to get rid of the S&P altogether.
Thank you for explaining that. We talked about trade optimism, and the market punditry talks a lot about trade optimism. Who do you think is going to be the biggest winners of either a full-scale trade deal or, a round 2 provisional, or any further progress? And how are we positioned to take advantage of this?
Good question. So let's go to this trade slide. Well, these are the these are the countries, that will be impacted the most when we have trade deals that are solidified. The countries that have the biggest exports are the companies that are going to be the ones that benefit the most. And you can see here, a lot of these countries are emerging market countries. And so that is why in June, in May, the president came out and increased his rhetoric on tariffs, and the market pulled back and had a horrible May. And the S&P 500 was down about 7-8%. Well, emerging markets were down, call it 15%. And so in June, at the beginning of June, we took an opportunity to say, hey, we think that there is going to be a trade outcome. We don't know what that's going to be, but we think there's going to be a trade outcome or a new president come 18 months from now. And we were willing to take a little bit of our U.S. exposure via REITs and via utilities and put them into emerging markets, developed international, and small cap. The same things that if we have a trade deal, emerging markets and international are going to, in our opinion, benefit more than the S&P 500. For the same reasons that the S&P 500 has done well over the past 18 months since the trade talks, the trade tariffs have started.
Makes sense. Thank you. I'm still not seeing any questions from any of the viewers at this time. Seeing, I don't know if you want to give any closing remarks.
I just want to say thank you to everybody who's joined our call today. The next time we have a call will be in 2020. So if we don't see you or don't hear from you, have a great holiday season, a great new year, and we'll talk very soon. Thank you. Goodbye.
Thanks, everybody.